$10,000 per ounce. That number sounds absolutely insane to most people, doesn't it? When I mention $10,000 gold to the average investor, they look at me like I've completely lost my mind. They think I'm exaggerating for effect, engaging in hyperbole, or simply trying to generate attention. But here's what they don't understand. $10,000 gold isn't a fantasy. It isn't wishful thinking. It's mathematics. And if you listen carefully to what I'm about to share with you, you'll understand not only why $10,000 is possible, but why it might actually be conservative. The market is whispering something right now that most investors are completely deaf to. But the smart money hears it. Central banks hear it. The top 0.1% of wealth preservers hear it. The question is, do you? Let me explain what I mean by the market whispering. You see, markets communicate in subtle ways before they make massive moves. They don't announce their intentions on the evening news. They don't send out press releases. They whisper through price action, through positioning data, through flows that only careful observers can detect. And right now, if you know how to listen, the gold market is whispering something extraordinary. It's telling us that the monetary system as we know it is approaching a breaking point. It's signaling that the assumptions investors have held for decades are about to be shattered. It's revealing that the smart money is quietly preparing for a monetary reset that will make current gold prices look like a joke in hindsight. Small investors must watch these signals carefully because your financial future depends on understanding what's happening beneath the surface. While the mainstream financial media obsesses over the latest quarterly earnings reports and daily stock market gyrations, something far more significant is unfolding in the gold market. Central banks around the world have been accumulating gold at a pace not seen in over 50 years. China, Russia, India, Turkey, Poland, Singapore, Hungary. Nation after nation is adding to their gold reserves while quietly reducing their exposure to U.S. Treasury bonds. This is not coincidence. This is not random portfolio rebalancing. This is coordinated preparation for a world where the dollar is no longer king. To understand why $10,000 gold is not only possible but probable, you need to understand the mathematics of the situation. Let's start with the most basic calculation, the inflation adjustment. Gold reached its all-time high of $850 per ounce in January 1980. If you adjust that price for official CPI inflation, which I would argue dramatically understates true inflation, gold would need to reach approximately $3,000 just to match that 1980 high in real terms. But here's what's critical. The CPI has been manipulated and modified over the decades to systematically understate inflation. If you use the original CPI methodology from 1980, the inflation-adjusted price of gold would be closer to $20,000 per ounce. $10,000 gold isn't even reaching parity with the 1980 high when measured honestly. Now let's look at another mathematical framework, the relationship between gold and the money supply. In 1980, when gold peaked at $850, the M2 money supply in the United States was approximately $1.8 trillion. Today, M2 stands at over $21 trillion, a more than tenfold increase. If gold were to maintain the same ratio to the money supply that it had in 1980, the price would need to be over $8,000 per ounce. And that's using current money supply figures. When the Federal Reserve is inevitably forced to restart quantitative easing, and they will be, that money supply will expand dramatically further. $10,000 gold becomes almost modest in that scenario. But wait, there's another framework that points to even higher numbers. Consider the relationship between gold and U.S. government debt. In 1980, the national debt was approximately $900 billion. Today, it exceeds $35 trillion. That's an increase of nearly 40 times. If gold maintained its 1980 ratio to government debt, we would be looking at gold prices in excess of $30,000 per ounce. Do you see the pattern here? Every mathematical framework I examine points to gold being dramatically undervalued at current levels. $10,000 isn't the ceiling. It's potentially just a waypoint on the journey to much higher prices. The market is whispering these numbers to anyone willing to listen. You can see it in the persistent central bank buying. You can see it in the steady depletion of COMEX inventories. You can see it in the growing premium that physical gold commands over paper gold contracts. You can see it in the increasing difficulty miners face in discovering new deposits. Every signal points in the same direction. Gold is preparing for a move that will shock the world. Let me give you some historical context because understanding the past is essential to anticipating the future. In the 1970s, gold rose from $35 per ounce to $850, an increase of more than 2,000%. This happened during a period of monetary chaos when the United States abandoned the gold standard, when inflation raged out of control, when faith in the dollar collapsed. We are entering a similar period today, but the conditions are even more extreme. The debt levels are higher. The money printing has been more aggressive. The fiscal deficits are larger. The political dysfunction is worse. If gold repeated a 2,000% move from its 2015 low of approximately $1,000, we would be looking at a price of $20,000 per ounce. You need to understand something fundamental about how gold bull markets work. They don't progress in a linear fashion. They experience long periods of consolidation followed by explosive moves that catch almost everyone off guard. The 1970s bull market had multiple corrections of 20 to 40% along the way, but each correction was followed by a surge to new highs. The final move in 1979 and 1980 was particularly violent. Gold roughly tripled in just over a year. When monetary confidence breaks, gold doesn't merely rise, it explodes, and we are approaching another breaking point. The Federal Reserve is trapped in an impossible position. They have raised interest rates to fight inflation, but they haven't actually solved the inflation problem. They've merely suppressed it temporarily while creating a host of new problems. The higher rates have stressed the banking system, as we saw with Silicon Valley Bank and the regional banking crisis. They have caused the federal government's interest expense to explode beyond $1 trillion annually. They have pushed commercial real estate to the brink of a crisis that could rival the 2008 subprime collapse. They have created an inverted yield curve that historically precedes recessions. Something is going to break under this pressure. It always does. When something breaks, and I believe it will break soon, the Federal Reserve will have no choice but to reverse course. They will cut interest rates. They will restart quantitative easing. They will flood the system with liquidity to prevent a complete financial meltdown. This is the playbook they followed every time a crisis has emerged since 2008. But here's the critical difference. This time, they'll be doing it with inflation still elevated. They'll be explicitly choosing to let inflation run hot rather than allow the financial system to collapse. This is the moment when the market's whisper becomes a scream. This is when gold goes parabolic. If you see what I see, you understand that $10,000 gold is not about gold becoming more valuable. It's about the dollar becoming dramatically less valuable. Gold is simply the measuring stick that reveals the dollar's true decline. When you hear about gold at $10,000, what you're really hearing about is a dollar that has lost 60 to 70% of its current purchasing power. This isn't speculation. It's the inevitable mathematical consequence of the monetary policies that have been pursued for decades and are now reaching their terminal phase. The top 0.1% of investors already understand this. They've been quietly accumulating gold for years through family offices, private wealth structures, and allocated storage facilities that never show up in public data. They don't talk about their gold positions on CNBC. They don't tweet about their latest purchases. They simply accumulate month after month, year after year, building positions that will preserve their wealth through the monetary chaos ahead. These are not people who panic buy after headlines. They position ahead of time when prices are still reasonable and availability is still assured. The geopolitical dimension adds another layer of urgency to the $10,000 thesis. The world is fragmenting into competing currency blocks. The BRICS nations, Brazil, Russia, India, China, South Africa, and their growing list of allies, are actively working to reduce their dependence on the dollar. They're creating alternative payment systems. They're settling trade in local currencies. They're accumulating gold as a neutral reserve asset that no single nation can print or sanction. As global demand for dollars decreases, the United States will find it increasingly difficult to export its inflation to the rest of the world. That inflation will come home with a vengeance, and gold will be the primary beneficiary. The mining industry provides another bullish signal that supports the $10,000 thesis. Despite gold prices at all-time highs, mining companies are struggling to replace their reserves. The easy deposits have been found. New discoveries are smaller, lower grade, and more expensive to develop. It takes 7 to 10 years to bring a new mine into production. Even if gold prices doubled tomorrow, the supply response would take a decade to materialize. This supply constraint means that when investment demand truly surges, as it will when the monetary crisis becomes undeniable, there simply won't be enough gold to satisfy that demand at current prices. The only way to balance the market will be through dramatically higher prices. I want to address the skeptics who say that gold at $10,000 would mean catastrophe, so why would anyone want that? Here's my response. The catastrophe is already baked in. The debt levels are unsustainable. The deficits are unpayable. The entitlement obligations are unfundable. The only question is whether you're going to be on the right side of this transition or the wrong side. The monetary reset is coming whether you buy gold or not. The only choice you have is whether you're going to preserve your purchasing power through it or watch your wealth evaporate along with the dollar. This isn't about rooting for catastrophe. It's about recognizing reality and positioning accordingly. The behavioral aspect of this situation is fascinating and frustrating in equal measure. Most investors are anchored to current prices and cannot imagine gold at dramatically higher levels. They said the same thing when gold was $300. 500 seemed impossible. They said it at 500. 800 was inconceivable. They said it at 1,200. 2,000 was fantasy. Now gold is above 2,000, and they're saying 10,000 is crazy. Yet the fundamental drivers that have pushed gold from $250 in 2001 to over 2,000 today have only intensified. The debt is higher. The money supply is larger. The fiscal situation is worse. Why would the trend suddenly stop? The mining stocks deserve special attention in a $10,000 gold scenario because they offer extraordinary leverage to gold's rise. Consider a mining company with all-in sustaining costs of $1,200 per ounce. At $2,000 gold, they make $800 per ounce in profit. At $5,000 gold, they make $3,800 per ounce. At $10,000 gold, they make $8,800 per ounce. That's not a 5 times increase in the gold price, producing a 5 times increase in profits. It's producing an 11 times increase in profits. This operating leverage is why quality gold mining stocks can rise 500, 1,000, even 2,000% during major gold bull markets. The whispers in the market are getting louder for those who know how to listen. The pattern of higher lows and higher highs that has defined gold's price action for the past several years is a textbook bull market structure. The consolidation between $1,800 and $2,000 that lasted nearly 3 years has resolved to the upside with a decisive breakout. The momentum is building. The foundation has been laid. The next major leg higher is approaching, and it could be the most powerful move in gold's modern history. For small investors watching this, the opportunity is still available, but won't remain so forever. You can still buy physical gold at reasonable premiums. You can still purchase shares in quality gold mining companies at valuations that don't reflect $10,000 gold. You can still establish positions before the masses wake up and rush into the sector. But this window is closing. As price rises and awareness grows, premiums will expand. Availability will become constrained, and mining stocks will gap higher before you can act. The time to prepare is now, while most investors remain focused on technology stocks and cryptocurrency. Let me be specific about what I recommend. Every investor should have significant gold exposure, not the traditional 5% allocation that mainstream advisors suggest, but 20, 30, perhaps even 50%, depending on your circumstances and risk tolerance. This should include physical gold in your possession or secure allocated storage, plus carefully selected gold mining stocks that offer leverage to higher prices. This is not a trade to flip for quick profits. This is a strategic position to protect your family's wealth through the monetary crisis that's approaching. The people who build these positions now will be the ones who thrive in the years ahead. $10,000 gold might sound extreme today, but remember, in 1970, the idea of $800 gold would have seemed equally absurd. In 2000, the idea of $2,000 gold was dismissed by virtually everyone. Prices that seem impossible become inevitable when the underlying conditions demand them, and the conditions today are demanding much higher gold prices. The debt trajectory demands it. The money printing demands it. The fiscal insanity demands it. The geopolitical fragmentation demands it. Everything points in one direction: dramatically higher gold prices measured in dramatically weakened dollars. The market is whispering its intentions to anyone willing to listen. It's telling you that the 40-year experiment in unlimited fiat currency is approaching its expiration date. It's signaling that the debt-fueled prosperity of recent decades was borrowed from the future and the bill is coming due. It's revealing that the only assets that will preserve purchasing power through what's ahead are those that cannot be printed, and gold is the ultimate example. If you hear what I hear, if you see what I see, you understand that $10,000 gold isn't a fantasy. It's simply the mathematical destination of current trajectories. The question isn't whether gold will reach $10,000. Given the fiscal and monetary situation, I believe that outcome is essentially inevitable over the next 5 to 10 years. The question is whether you'll be positioned to benefit when it does. Will you be among the small percentage of investors who saw what was coming and prepared accordingly? Or will you be among the masses who ignored the warnings, dismissed the signals, and watched their purchasing power evaporate? The choice is yours, but the window to make that choice is narrowing rapidly. The whispers are becoming louder. The patterns are becoming clearer. The smart money is moving. Central banks are accumulating. The fundamental case has never been stronger. $10,000 gold is not a question of if, but when. And when it happens, it will seem obvious in hindsight, just as $2,000 gold seems obvious now, despite being dismissed as impossible just 15 years ago. Don't wait for the obvious moment. By then, the opportunity will have passed. Act now while gold is still whispering before it starts screaming. Your financial future may depend on whether you listen to what the market is telling you today.